Hi everyone, welcome back to this week's Technical Insights. Global indices suffered another week of setback going into the second week of second quarter as we start the first quarter earnings seasons. Most global indices around the world ended in the red for the second consecutive week of losses as inflation concerns once again dented investor sentiment. A broad decline in US major bank shares also weighed on the market. The key macroeconomic data that investors were watching last week was the US CPI numbers, which came in 0.1% higher than consensus for both the month-on-month inflation rate as well as the core inflation rate. Oil price also continued their rise on reports that Israel is preparing for a direct attack by Iran last weekend, in what would be the biggest escalation of tensions in the region since the outbreak of the Israel-Hamas war last October. US crude settled at $85.66 a barrel after rising above the $87 mark. This added fuel to the inflation concerns that have put pressure on the market for the past 2 weeks. Before we dive in further, let's do a quick recap of how the market have ended last Friday. Our Singapore Straits Times Index closed lower on Friday, falling 10 points or 0.33%. In Asia, the market largely ended in the red. Japan Nikkei 225 index managed to end on a positive note on Friday, up 0.21% and ended its 2 weeks losing streak. Shanghai Composite Index slipped lower by 0.49%, while Hong Kong Hang Seng Index tumbled 2.18% on Friday. China and Hong Kong stocks were impacted by China deflation concerns and the moderation of US rate cuts expectation. Hong Kong property sector led the losses amid worries that borrowing costs will remain elevated for a longer time. On the US side, the Dow Jones Index dropped about 475 points or 1.24% on Friday. At one point in the Friday trading session, the Dow lost nearly 582 points or 1.51%. The S&P 500 was down 76 points or 1.46% and pulled back as much as 1.75%. The Nasdaq Composite Index tumbled 267 points or 1.62%, the worst performer among the 3 US indices on Friday. For the week, all 3 major US indices notched weekly losses. The 30-stock Dow Jones Index ended 920 points lower or down 2.37% to close the week at 37,983 points. Broad index S&P 500 lost 80 points or 1.56% to settle at 5,123 points. Tech-heavy Nasdaq Composite Index surprisingly did not pull back as much as the other 2 US indices, losing just 73 points or 0.45% to finish the week at 16,175 points. JP Morgan shares declined more than 6% after the banking giant posted its first quarter results last Friday. The bank net interest income, a key measure of what it makes through lending, came in short of what markets are expecting, and the CEO, Jamie Dimon, also warned about persistent inflationary pressure weighing on the economy. Wells Fargo also slipped 0.4% after reporting its latest quarterly figures, while Citigroup dropped 1.7% despite posting a revenue that beat analyst estimates. In Asia, Hong Kong market returned from their 3-day short trading week and finished the full trading week little change, down just 0.01% to end at 16,721 points. The Hang Seng Tech Index, however, gained 0.68% to 3,474 points. Alibaba Group Holdings fell 3.4% to Hong Kong dollars 71.65 on Friday, giving up some of the gains posted earlier last week from the morale-boosting comments by its founder, but still ended the week positive with a 2.28% gain, which contributed to the Hang Seng Tech Index gain last week. Week to date, our STI index tracked the decline in the US indices and fell 0.04% to settle at 3,216 points for its second consecutive losing week. The top performer on the STI index we saw last Friday were Jardine and Carriage, up 19 cents or 0.71%, and DBS up 12 cents or 0.33%. So let's go to the charts and see if both stocks will continue the rebound and rise further in the next few weeks. First, let's look at Jardine and Carriage. Their share price hit a high of $34.52 on the 30th of June last year and has since been on a downtrend. The share price hit a low of $23.76 this year on the 12th of March. Year-to-date high so far was observed on 2nd of January around the $30.10 level, which was also the high that we saw on the 22nd of November last year. So the $30 handle would be a strong resistance level to watch out for. Below this level, we saw a bit of recovery in the first 2 weeks of February over here, where the share price rebounded but fizzled out at the $27.22 level. Last Friday closing price at $26.90 is coming very close to this level of $27.22 in February. And the 100 days moving average, which is the blue line that you see here, is also at the $27.07 mark. So the $27 handle will be the immediate resistance to watch out for Jardine CNC share prices. Key support level will be the 50 days moving average, which is the amber line that you see here, as well as the 20 days moving average at the white line that you see over here, now at around the $25.32 and the $24.65 level respectively. On the indicators, the MACD is still showing very strong momentum, with the MACD line diverging away from the signal line upwards. On the RSI, the latest reading last Friday at 70 points is already testing the 70-point overbought level. Hence, this may be a signal that we may see a pullback in Jardine Cycle and Carriage share price soon. So with the RSI now in the overbought territory, investors and traders looking into buying into this rebound of Jardine CNC would be better off getting in nearer on the 50 days or the 20 days moving average at $25.32 or $24.65 respectively. Next, let's take a look at DBS Group holdings. We did a video on DBS on the 13th of February video. In that analysis, we identified the $32 level as the key support level, as well as the resistance level at $33.64, which was tested within a week. DBS Bank share price then continued the run up using the 20 days moving average as a key support level and hit a high of $36.18 last Friday. With the inflation remaining sticky so far this year, interest rates are expected to stay high for the time being, which is beneficial to our local banks. Recently, UOB Kay Hian adjusted its target price for DBS to $43.25 from the $40.75 level and kept its rating at buy. So it will not be a surprise to see DBS test the $40 level very soon. Immediate support level for DBS come in at a 20 days moving average, currently at $35.26. The next support level would be around the lower bound of the Bollinger Band and the 50 days moving average at $34 or $33.70. Immediate resistance level will be the upper bound of the Bollinger Band, now at $36.53, before we see the $40 mark and above target price of some of the analyst projections. On the indicators, we do have a negative reading on the MACD indicator, signaling that there's negative momentum and price may pull back lower soon. On the RSI, we have a reading of 69 points, which is 1 point away from the 70-point overbought mark. So a short-term pullback in the near term is likely possible. Hence, investors and traders looking into joining the uptrend in the DBS share price run may use the 20 days and 50 days moving average as key reference level at $35.26 or $34 respectively. And these are the updates that I have for you this week. Thank you for tuning in. As always, do remember to like, share, and subscribe to stay updated with the latest market developments. And I'll see you again next week in the next Technical Insights.